What if China cut off rare earth metals, the U.S. slapped new tech bans, and the dollar started to fall? Not slowly, but relentlessly for months. Sounds like a nightmare, right? Yet this is exactly the crisis unfolding behind the scenes of the latest U.S. China trade tensions. In May, Washington quietly triggered a global panic, not with tariffs, but with a complex spreadsheet, threatening a global tax war, derailing trade talks, and forcing U.S. banks to absorb risky bond market losses. The crisis is already in motion. Even America's closest allies are nervously pulling back. Trump calls it negotiation. Markets call it a crisis. So if China refuses to back down and the U.S. stays firm, what breaks first? Trade, trust, or the financial system itself? Earlier this year, Trump claimed he'd made a quick deal with China to stop civil unrest and factory shutdowns in Beijing. But reports showed otherwise. China's industrial output actually rose by 6.2% in April. Still, a 90-day tariff truce was agreed in Geneva, lowering U.S. duties to 30% and China's to 10%. However, simultaneously, the U.S. Commerce Department slapped sweeping bans on China's access to chip design software and key chemical shipments, revoking even previously approved export licenses. Beijing's silence suggests it sees these moves as sabotage, not containment. Treasury Secretary Scott Bessent rushed to Switzerland to broker a short-term truce, cutting $145 billion in tariffs. But China's promised easing of rare earth export controls hasn't happened. These rare earths are critical for AI chip manufacturing, yet export delays persist. Trade officials say China is using strategic ambiguity, delaying exports under the guise of regulation, holding on to leverage while the U.S. scrambles to maintain credibility. Meanwhile, Wall Street has turned U.S. trade policy into a game of brinkmanship. The Financial Times coined the takeout strategy, where markets plunge after tariff threats only to bounce back when Trump retreats. For example, the S&P 500 surged 2.1% after Trump postponed a 50% tariff on European imports. Investors are growing wary, however. Moody's downgraded the U.S. credit outlook due to fiscal volatility. If Trump suddenly decides to stand firm, markets that rely on his usual backtracking could face serious shocks. The economic data reveals the fallout. U.S. goods imports plunged nearly 20% month over month, the steepest drop ever recorded after new tariffs. Consumer spending, which fuels nearly 70% of GDP, slowed dramatically. Households that stocked up early are now pulling back, squeezed by rising prices and uncertainty. The U.S. dollar is also showing cracks. Since December, the dollar index has dropped almost 5%, with June expected to mark its fifth consecutive monthly decline. Foreign investors who hold over $7.5 trillion in U.S. assets are reconsidering their bets amid political instability and unpredictable trade policy. A weaker dollar usually boosts exports, but when exports are collapsing and consumer demand is flat, the benefit disappears. The real danger is a loss of confidence that could unravel the global financial system. Treasury auctions are becoming riskier too. Regional banks now sit on billions in unrealized losses from treasury bonds. So what breaks first? The bond market? The dollar? Or the illusion that Washington still controls the game? The stakes have never been higher. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.